ETH, which started later in 2016, well, that's done 324,000% returns, and Solana has done 8,300% returns since 2021. When you look at the annualized performance, Bitcoin is 139% a year, ETH 146, Solana 203. Then we go down to the next best performing asset, technology. This is the NASDAQ, not the exponential age basket that we built in Pro Macro, GMI, and the exponentialist, different variations of it. This is just the NASDAQ. It's done 17% returns. So the NASDAQ has managed to outperform the Fed balance sheet, the global liquidity plus inflation by a few percent, actually by 5% a year. That's okay. Nothing else, no other asset has outperformed the debasement of currency plus inflation. Not one. The S&P roughly keeps you flat. Everything else, your future self is poorer from owning it. This is profound in your understanding of asset allocation. Once you realize this, you realize you're wasting your time trading other stuff. You really are, because you are not going to compound the returns that you need for your future vision of yourself to be wealthier. So let's take NASDAQ, which is the best performing equity market in the world, bar none, over the last decade.
Recently, Real Vision CEO Raoul made a striking case for the superiority of cryptocurrencies over traditional assets, and why crypto is bound to be massive shortly, based on their impressive returns and resilience. Cryptocurrencies, as Pal observes, are in a secular trend, which means they are likely to go up in price over the long term. Pal notes that despite significant pullbacks in the past, Bitcoin was able to deliver an astonishing return of 20 million%. Ethereum, which started later, has achieved 324,000% returns, and Solana, since 2021, has provided 8,300% returns. Meanwhile, the NASDAQ has provided a 17% return, which has managed to slightly outperform the Federal Reserve's balance sheet growth and global liquidity, plus inflation by about 5% per year. With this comparison, it's obvious that no other asset class, including the S&P 500, has been able to outpace the combined effects of currency debasement and inflation other than crypto. We will now bring you clips of Raoul as he shares his latest crypto forecast. Give this video a like and subscribe to the channel to show your support. Thanks and enjoy.
I'm going to start with a chart that most of you have kind of seen me talk about, and you're going to really understand why it matters. I mean, I tried to put this together in tweet threads. I try and put it together in for ways for you to understand, but this is going to give you the full understanding. Liquidity is everything. It is increasing on a globalized level at 8% a year. This is the global hurdle to all investments that you make. Anything that doesn't beat this is actually making your future self poorer. You can also add in, let's say 4%, 3 or 4% global inflation. So you've got a 12% hurdle rate. That is staggeringly difficult to beat. But if you don't, your asset allocation is going to make your future self poorer. And that is the big deal that we've got. The thesis that I'm about to outline is also based on the fact that once I started digging into the debasement trends, I realized there is two and only two massive secular trends in the world. One is cryptocurrency. This is the log chart of Bitcoin, which over time, as we know, has produced since 2012 alone, 20 million% returns. No asset has ever come close to this in all recorded history. The other mega trend, it's such a beautiful exponential trend, is the NASDAQ. Since 2008, it's been a perfect trend. These are secular trends that are outperforming everything. They're based on adoption curves and technology, plus flow of capital. Because they outperform, they tend to outperform more. But I'll come on to the importance of these. But these are the two key assets that matter to me when I'm talking about portfolio allocation, because everything else, as you'll see, is actually secondary. So here's Bitcoin, because it's got the longest price history of all crypto. Here you've got about an 85% correlation with liquidity. Why is it not high? People think, well, this is all just a liquidity thing. No, it's liquidity plus technological adoption. And that technological adoption is what drives the outperformance, which lowers the correlation. But it's, again, staggeringly high correlation. Liquidity is everything. It's something I've tried to get across. The everything code is the understanding that liquidity is everything. It's there for a reason. All the governments and central banks understand that reason, which is we can't have a debt crisis. If you debase currency, you can't also have a stock market crash where the main market is down 50, 60%, because all you need to do is debase the currency and by magic, the market goes up. You guys can all remember what happened in 2020. That was debasement of currency that stopped the asset side collapsing, which would have brought down the house of cards because assets are collateral for all of the debt. So you can't have, we've taken out that left-hand skew of the markets, which is the ability to crash, because all they need to do is turn on the magic money printer and it all goes away, even though it hasn't really gone away, as we know. You're all paying for it by this tax, which is a debasement tax of 8% a year plus the inflation. Again, money printing doesn't create inflation. Inflation is based on inflation as in CPI is a variable asset thing, which is goods and services that are supply and demand. That's not driven by this. This drives assets and scarce assets only. It does not drive wages. It does not drive earnings. It does not drive commodity prices. It does not come out all of these things where people's narrative is confused. They're looking at the wrong thing. They're confusing debasement with inflation. And this is where it gets bananas, which is a word you'll hear us use a few times. It's so arrogant and stupid to think that you can just simply break it down. Here's a 4-year cycle and it breaks down to simple 4 years, but it does. And it has done since 2008. And what you've got here in this kind of overly colorful thing is, you've heard me talk about this, macro spring in green. That's when the economy starts thawing because liquidity is starting to rise. Then summer comes and liquidity starts really moving. And then fall is when you really often get a large injection of liquidity before eventually we go into winter, which is the blue, and liquidity shrinks as the central banks pull liquidity out of the market to try and cool inflation and the economy overall. And they've been doing it perfectly. These debt cycles also happen to be the US presidential election cycle, because it so happened that 2008 was the presidential election cycle year. It's also the same as the Bitcoin halving cycle, because Bitcoin was 2008. So we've got one mega cycle that rules it all. It's the most powerful cycle we've ever had. And most people can't see it or don't yet understand it. And it makes them be wrong in their understanding of how everything works. And you can see it, people trying to explain things on Twitter without understanding what really moves things. But when you understand that same grid of colors, the same seasonality, understanding that each of these was an increase or decrease in liquidity, well, when you look at the NASDAQ, and we've proven how NASDAQ is correlated, NASDAQ breaks down exactly by the seasons too. NASDAQ does well in summer, which is we're in now, or just transitioning into, but it does really well at the end of the cycle in fall. It tends to have a momentum. It's kind of a reflexive process, which really builds on itself, because in fall, earnings are at peak. So equities are driven by earnings plus the investment cycle. People have got more money to invest. So fall, so that would be equate to 2025, should be really strong for tech and strong for this year too, which is summer, coming off green, which tends to be very good with spring too. So this is this exponential age tech trend that I talk about. But crypto, same cycle. This is the crypto cycle. We can call it crypto spring, crypto summer, crypto fall, crypto winter. It's the same as the election cycle. It's the same as all the thing. The presidential cycle. They're all the same. So crypto tends to do decently well in spring. The anomaly was 2020 because of the pandemic. It did very well in spring, less well in fall. Generally speaking, like the NASDAQ, fall is when the real price action starts. My guess is we'll probably be more similar to 2017, 2013, this cycle, because we're not jamming excess liquidity in early, it'll accumulate over time. But anyway, now you understand the cyclicality, why it happens, based on liquidity. You understand liquidity itself and why liquidity is there. What its job is to do is debase the currency to pay for the debt. That's making the rich get poorer, the poor get poorer. It means your wages don't go up as much as the cost of housing.
Central banks manipulate liquidity by injecting or withdrawing money from the market. This manipulation is done to manage inflation and maintain economic stability. However, it also leads to currency debasement, which erodes the value of money over time. According to Pal, the best way to escape this problem is to allocate investments towards assets that have historically outperformed the erosion of currency value, such as cryptocurrencies, like Bitcoin. Bitcoin has demonstrated remarkable gains over the past decade, outperforming other asset classes in 8 of the last 11 years. Its returns have been substantial, with impressive percentages over various holding periods. That said, Pal urges investors to consider allocating a portion of their investment portfolios to Bitcoin or similar cryptocurrencies to safeguard their wealth and potentially achieve higher returns in the face of currency depreciation. Now let's get back to the video.
The crypto supermassive black hole, as I'm about to explain to you, means that really there's only one asset that matters. And then we'll come on to the final one, which is the banana zone that you all love. So again, we go back to the total liquidity chart. This is how you are being fucked. This is what you need to unfuck yourself from is the debasement of currency. Crypto's giving you that. It's also that tech adoption, and it's your route out. So at Xpan, we built out this table that I put on Twitter. I put it on every month. But look, it's a noisy table. But what it's showing, if you go to the bottom of this, the light blues are each year from 2011, crypto is the best performing asset 3 years out of 4. In the 4th year, it's the worst. So macro winter, it's a terrible asset. Well, terrible asset, the lows are always higher than the previous lows. It's in a secular trend. You don't even need to worry about it. If you just own it, you just own it. But the other years, it outperforms everything else, bar none. But then when you put that together, even with the numerous 85% pullbacks, Bitcoin's done 20 million % returns. ETH, which started later in 2016, well, that's done 324,000% returns. And Solana has done 8,300% returns since 2021. When you look at the annualized performance, Bitcoin is 139% a year, ETH 146, Solana 203. Then we go down to the next best performing asset, technology. This is the NASDAQ, not the exponential age basket that we built in Pro Macro, GMI, and the exponentialist, different variations of it. This is just the NASDAQ. It's done 17% returns. So the NASDAQ has managed to outperform the Fed balance sheet, the global liquidity plus inflation by a few percent, actually by 5% a year. That's okay. Nothing else, no other asset has outperformed the debasement of currency plus inflation. Not one. The S&P roughly keeps you flat. Everything else, your future self is poorer from owning it. This is profound in your understanding of asset allocation. Once you realize this, you realize you're wasting your time trading other stuff. You really are, because you are not going to compound the returns that you need for your future vision of yourself to be wealthier. So let's take NASDAQ, which is the best performing equity market in the world, bar none, over the last decade. And we look at it versus Bitcoin. It's down 99.92%. Get your fucking heads around that. That's the difference between the next best asset beyond NASDAQ. It's alien. This is the biggest macro trend of all time. And it's so powerful that anytime you take money out of crypto and put it into anything else, you're going to lose money. So therefore, the only thing you can take crypto money out of is lifestyle, because lifestyle is priceless. Everything else is priced on a relative basis. And what you find is everything goes down. It's why a lot of people in crypto hold out to buy property until they're ready to, because property gets cheaper if your denominating currency is Bitcoin or another crypto.
How do you think the increasing adoption of cryptocurrencies will impact traditional financial systems in the future? Do you think it would lead to the discontinuation of fiat altogether? Share your thoughts in the comments section. If you found today's video informative and would like to receive more insights and updates on cryptocurrency and global finance, please consider liking the video, subscribing to our channel, and enabling post notifications. Be sure to stay tuned for our next episode, where we'll uncover more about the fascinating developments in the crypto space. Until then, keep questioning, keep exploring, and most importantly, keep investing wisely. Thank you for watching, and we look forward to seeing you in the next video.